Hey, welcome back to YT Finance, and this is the channel where I went to business school so you didn't have to, and today we are talking about AFRM Stock, C3AI Stock, CPNG Stock, and PaySafe. We're going to be going over what analysts think of these companies, the good and bad news regarding the recent price developments for these various stocks, and what I personally think about the future growth projections. So we're going to start off with AFRM, because AFRM's share price has recently dropped around 21% to $46 per share. The ticker symbol for AFRM is AFRM, and it currently trades for around $46 per share. The low-end analyst price target for the next 12 months is $45, the average price consensus is $88, and the high-end price prediction, according to analysts, is $166. So ideally, we would want the AFRM stock to be trading below their low-end price target of $45 per share, but $46 per share is not that bad, and this is because recently the stock has fallen around 21% due to the company reporting their second quarter results ahead of schedule. The expectations for these results were a loss per share of 57 cents, and revenues were anticipated to come in at around $328.8 million, but they actually came in at $361 million, which is good news. However, despite this good news, the stock still plummeted. AFRM also said in a statement that they anticipated full-year revenues to come in between $1.29 billion and $1.31 billion worth of revenues, which fits in between analysts' expectations of $1.27 billion. Now, one of the reasons that the stock price fell is because they accidentally released their earnings report ahead of schedule. In a tweet, AFRM said that they announced the details of the company's financial performance on accident early. However, despite this early leak of their revenues, their sales ended up rising by 77%, which is pretty good news. This is even a larger increase than what analysts were anticipating and projected, because analysts forecasted that their sales would only rise by around 61%. So it's always good when a company can beat revenues, earnings, and even growth predictions by analysts. AFRM is one of the hottest buy now, pay later companies, and this is a gigantic market which has fantastic growth capabilities for the future. For instance, if a user buys a $1,450 Peloton bike, they can pay that overall principal off over 39 months by just paying around $45 through AFRM. So you're basically financing everyday items, and AFRM also has a fantastic partnership with Amazon. So a really strong partnership here by AFRM. AFRM, if you didn't know, went public in January of 2021, and their share price has fallen around 64% from its peak. But does this mean that the stock is currently a good buying opportunity? Well, overall, I would rate this stock around a 6.5 out of 10. I do own this company, but I don't have a lot allocated for this particular company. I just think that it's a good company that has fantastic partnerships that could give me great future growth returns. So overall, this pullback could be a good buying opportunity. However, the stock price could continue to fall. Again, we are not trading below the low-end analyst price target, so we really would want to buy the stock below $45 and around the $35 mark if we can. So overall, I would rate AFRM as a pretty good average company. I'm not bearish or bullish on this company, but I do own this stock because I want to be diversified into a buy now, pay later company such as AFRM. Now I want to talk about C3AI stock. So the ticker symbol is AI, and this particular company is a pure artificial intelligence play because the world is moving toward more artificial intelligence. Businesses are utilizing this, the military is utilizing this, and overall the entire world eventually could be ran by artificial intelligence. Currently, AI stock trades for around $25 per share. The low-end analyst price estimate for the next 12 months is $31. The average price consensus among professionals is $55, and the most bullish price prediction that I could find according to analysts is $103 per share. C3.AI stock has fallen around 85% from its all-time highs, and their cash on hand currently makes up around 40% of the overall market cap and the worth of the overall company. They also have an outstanding $100 million share repurchasing program that is going to come through, and this is not only going to increase the stock price, but over the long term, it shows that the company is very confident that their stock price is going to grow over the long term. C3.AI is reasonably reasonably cheap right now, and it does have decent growth expectations. AI is definitely something that you would want to diversify into to have an overall healthy portfolio. AI also has the opportunity to present investors fantastic upside potential in the future. C3.ai went public in 2020, and now it's trading at around an 85% discount. As you can see from the chart here on screen, you can see that originally it was appreciating very nicely, but then all of a sudden the stock absolutely just started to plummet. This is due to a multitude of factors, including macroeconomic factors, but overall investors think that the stock is just not priced fairly right now and that it could continue to fall. The good news about the stock price falling is that it has also lowered their overall PS ratio, which currently sits below 11. Right now, the PS ratio, or price to sales, sits at around 10.61, and this is relatively good for a growth stock, specifically a growth stock in the AI market. Analysts expect very strong future returns for both revenues and overall financial metrics. For instance, AI delivered around a 41% year-over-year revenue growth rate, which is fantastic news for the company as well as their investors, and they also had a very notable improvement of a 30% CAGR quarter-over-quarter. So as you can see on screen, we see this fantastic positive slope for their overall total revenues for the full year of 2019 well into the full year of 2022. So as long as they can maintain this positive slope and this very impressive CAGR for their revenues of around 37%, this is really good overall news for the company. However, like many other growth companies, specifically in the technology markets, the revenue growth that they have experienced has not led to an improvement in profitability. AI, or C3.ai, saw no improvement in its non-general accepted accounting principles margins because it actually deteriorated at a loss of around 39%. However, this is expected for a company like this because it's aggressively reinvesting any revenues or any cash that it has on hand to bolster its research and development and S&M. On the bright side, AI, or C3.ai, guided very positive news for their next quarter with projected revenue growth between 34% to 38%. So if you can see on screen, you can see their overall revenue guidance, and overall it's really positive. So now that we know what we're working with and what type of company this is, where is this company going to be 5 years from now? Well, first off, they have very good partnerships. One that I want to bring up is Baker Hughes, ticker symbol BKR, and this is a very important customer in the energy sector. They contracted C3.ai with a $357 million contract, which will be spread over 3.5 years. We have another chart on screen where you can see year-over-year revenue increases, and we can see that we would ideally want to get into C3.ai in 2024, because from 2024 to 2025 is where they have their largest revenue increase, specifically on a percentage year-over-year growth basis. So ideally, we wouldn't want to invest into C3.ai right now, and we could just wait for the stock to drop lower for it to have a better PS ratio than it already has. Specifically in 2024 to 2025 is where we're going to see the most impressive growth from this overall company. But if you don't want to take that chance of missing out, you could always just invest into the company now with just a small portion of your overall portfolio. AI also does work and contracting work for the Department of Defense. They landed a contract that is worth $500 million, and this revenue is going to be spread over the next 5 years. So this provides a great growth runway for this overall company, and that it has stable, consistent revenues from this contract. Because C3.ai is a growth stock, investors typically would rather invest into the company now so the company can eventually grow into its overall valuation. And currently right now, like we said earlier, it's trading under 11 times its sales, which is a reasonable valuation. However, it's not a fantastic deal. The good news is that C3.ai trades at a market cap of close to around $2.5 billion, and the good news is that it has $969 million worth of cash and or cash equivalents on its balance sheet, which means that its market cap is made up of around 40% just cash from their balance sheet, which is really good to see. More good news is that the company does plan to repurchase around $100 million worth of common stock, which is going to raise the overall price per share. So with a decent cushion of cash and cash equivalents on their balance sheet, and the company repurchasing their shares, which just shows how confident this company is about their future stock price appreciation, this may be a good stock to at least put on a watch list. Overall, C3.ai is a stock that could give us stable growth over the long term and the coming years. For instance, just in 5 years at a 30% CAGR or compounding annual growth rate referring to their revenues, that could give us around 300% upside from current levels. But this is a double-edged sword because if AI is unable to grow or sustain their revenue growth rates, the stock would continue to plummet and there will be no real path toward profitability for the overall company. This company is also in competition with other artificial intelligence competitors such as Palantir Technologies, ticker symbol PLTR. But luckily for both companies, AI is such a giant market that there is room for multiple winners. So overall, I would rate C3.ai stock a 5 out of 10. And I personally do not own this particular company. I will wait and put it on a watch list and invest into the company at a later date. Now I want to talk about Coupang, ticker symbol CPNG. This is an e-commerce giant that is in Asia. The current stock price trades for around $22 per share. The average price consensus among analysts is $33. The low-end price target is $27, and the high-end price prediction, according to analysts, for the next 12 months is $52 per share. Recently, the CPNG stock has dropped around 22.3%. This company is also not a profitable company, but they do have an impressive growth profile. Their net sales increased around 48% year on year to $4.6 billion in the third quarter of 2021. They also have gross profits that surged around 62% year over year to $754.5 million. And according to the consensus among analysts, Coupang has very impressive top-line growth and that this top-of-the-line growth could continue. Specifically, their revenues are forecasted to jump at around 30.7% to $24.2 billion for the full year of 2022, and that will slightly decelerate to only a 24.1 year-over-year percentage increase in 2023, which means for that year they could bring in around $30 billion in total. However, the company did have a net loss in quarter 3 of 2021 that expanded at a rate of 87% year over year to $323.9 million. CPNG also has a net loss and it's expected to slightly decelerate in 2022. They do have a comfortable cash net position on hand specifically for their balance sheet because according to the third quarter financial results for 2021, they had around $3.11 billion worth of cash and or cash equivalents on their balance sheet. Coupang, like I said earlier, is not a profitable company at the moment, and it's trading at a price to sales ratio of 2.34 times. So this is very competitive to others in the space right now. So it is good to see that they have a competitive price to sales ratio at the current stock price. Coupang is not supposed to deliver profits for the next 2 years. So again, in my opinion, just like C3.ai, I personally would wait 1 or 2 years until this company shows greater growth prospects and projections, or until the company actually turns profitable. And this would lower the risk on investors' parts, because what if we invest into this company and it doesn't turn profitable, analysts are wrong, and it really doesn't pan out in the future? We could have used that money and invested it into an ETF or a much better stock, and we could have made money instead of losing money. So I personally would just wait, just like C3.ai, so I can start seeing the historical value and the growth rate of this company over the next few years. So overall, I personally would rate this company a 5.5 out of 10, specifically for the short term. This is only a 12-month prediction, and these numbers could always change because I'm always willing to change my mind if the company starts to accelerate again. Now, lastly, I want to talk about PaySafe, ticker symbol PSFE. The current PaySafe PSFE stock trades for $3.50. The low-end price target is $4. The average price consensus for the next 12 months is $6.39, and the high-end price prediction, according to analysts, is $13. But is right now a good time to buy PaySafe? So it would depend on what type of investor you are and how you can stomach volatility. PaySafe, if you didn't know, is a transaction processor that specializes in sports betting and cryptocurrencies. So first I want to talk about its very lucrative niche, such as its sports betting. So PaySafe actually has deals with major online gambling platforms, including Microsoft. So this is absolutely phenomenal news. They also have a good niche market in the cryptocurrency market, So if you are a believer in cryptocurrency and the crypto revolution, this could be a good indirect cryptocurrency play. PaySafe is currently looked at as a growth stock. However, it's not growing. The revenue was around $377 million for last year's March quarter and $353 million for the September quarter. However, the company did end the year with around $1.46 billion worth of cash on hand, but by saying that, we also have to look at their debt because their debt came in at around $2.2 billion. Analysts also are expecting a small profit on revenues of $357 million. That would bring the 2021 revenue to just short of $1.5 billion against a $2.47 billion market cap. I also want to add that these two niches, specifically sports betting and cryptocurrencies, are currently out of favor for the overall market. But I think that eventually these will come back into favor, and it could very positively impact PaySafe as a company and their overall stock price. So if you are ready to buy the dip and you have patience for this company to continue to grow, this could be a good buying opportunity, which is why I rate this company a 6 out of 10. Now, the reasons for the ratings for all 4 of these stocks is that I have other stocks that are very similar and are in the same market sectors and industries that I just think are performing much better than these companies. But to get that information, remember to go and smash that like button right now so you always can stay informed with the next video that I upload. Subscribe if you are new, smash that like button, and I will see you in the next YT video.